Happy Sunday from Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, November 3rd, 2024. Today, I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions as we head into the presidential election on Tuesday. In today's podcast, I'm going to show you some of the key charts and metrics that we think are the most important ones in determining whether we should be buying or selling once the election is over. What makes Asbury Research different from other research and asset management firms is that we are totally data-driven. All we're doing is we're reading the data. We're not trying to predict what the Fed might do or who's going to win the election, but rather watch what key indicators are doing going into the election and right after the election to determine what the market thinks, because the market's opinion is the only one that matters. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com, which I am at right here, and click the contact tab, which I'm pointing to right here, or you could just click the link in the description of this video down below. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of quick announcements. Number one, we are currently offering a 2-week free trial to our Asbury Research Premium Research. This is not the Substack newsletter. We still have a free Substack newsletter that you can get to by going to asburyresearch.substack.com. This is the premium research that we've been doing for 20 years. All you need to do is click on the contact tab here, type FTM for Following the Money, FTM podcast 2 weeks free in the text box to take advantage of this. The offer ends on November the 15th. Today's the 3rd. So less than 2 weeks to go. If you're interested, please act now. Next, I was interviewed on Wednesday, October 23rd by IBD. The interview was close to an hour long and included our latest research with updates on most of our models, including the Asbury 60 correction protection model and the CEF model. You can view the video at asburyresearch.com by going here to About, clicking, and scrolling down to videos and clicking. Finally, we have recently combined our own models to create 4 model portfolios. We are going to take a closer look at one of these today, the Asbury Ultra Conservative Portfolio. So let's change views here, and we'll start at the beginning. For the Asbury Ultra Conservative Portfolio, we have many different kinds of clients. Most of our clients tend to be older, a little more conservative, a little bit more risk averse, and a little more wealthy. But we have different risk appetites throughout the spectrum of all of our clients. Again, I've been doing this for a long time, and our clients are pretty diverse in what we're looking for. We created this one for those clients that have approached us and said, I don't care if I am not outperforming the S&P 500 every year. I don't even care if I'm a relative performer versus the S&P. If I'm trailing the S&P by 2 or 3 percentage points a year, but I can keep my drawdowns to under 10%, so I can sleep at night. So I don't have to worry about taking a big hit in the market and then sweating it out until I can make that money back when I'm over 60 years old. So for that, we put together this portfolio. This is the newest of the 4 portfolios. I'll show you where to find those in just a moment on the website. But this is a blend of our CPM model, the correction protection model, which we're going to be giving you the latest signal to in just a minute. Our CEF model, which is our sector rotation model, and also a cash equivalent short-term bond fund, which is BIL, is the ticker that we use. So we put these together, and what we came up with So this is going back to the latter part of 2019, and you can see that the S&P 500 has, for the most part, outperformed it, which is in blue. That's the blue line here. But the green line, which is the portfolio, look at this nice, even sloped upward slope. That's what we were looking for. You don't get a lot of these zigs and zags like we're getting with the S&P 500. Less volatility. I'll show you specifically and quantitatively in just a minute. You can see over the past 5 years, it has annualized. It's been at 11.2% compared to 14% for the S&P. Over the past 3 years, again, the green is the portfolio, blue is the S&P. 9.5% for the portfolio, 8.8% for the S&P. Trailing 12 months, you can see it's trailing the S&P by quite a bit, 16.6 versus 34.4 for the S&P, which the S&P has had a pretty incredible year. It's been up as much as 42% since late October of last year, just about a year ago. And here's the year to date. You can see it's trailing again quite a bit, 10.9% for the portfolio versus 20.5. This is not going to have the same relative outperformance or underperformance every year, but we're looking at the bigger picture. That's why I think looking at this chart is important. And here's the cumulative returns 3 years. So the difference is this little orange spot here. This is a drawdown in the S&P 500, and this is how quickly the drawdown was recaptured by the model, because we really didn't have a drawdown. Let's take a look at this further, and I'll show you what I mean. So this is cumulative returns over the past 1 year on top. But what I want to show you here is the risk 5 years out. Standard deviation in the S&P is 18.2. Standard deviation here is only 6.9%. It's 2/3 less. Our beta is always 1% for the S&P, since that's the benchmark. Beta is 0.35. Again, it's 2/3 less. Look at our maximum drawdown, 33.9% for the S&P 500. In case you were wondering, that was during COVID, but 9.3. That's the biggest drawdown that this portfolio has had over the past 5 years. And again, over the past 5 and 3 year periods, it's stayed relatively close to the S&P 500. This has been an extraordinary year. The market's gone up 42% in a year, like I said earlier. The Sharpe ratio, 1.26 is an extremely good Sharpe ratio. Sharpe ratio basically measures how much performance you're getting from the strategy versus per unit of risk. The higher the Sharpe ratio, the better the performance on a risk-reward type of basis. So again, if you're interested in these, let's change the view here. And just go here to Asset Management, and you'll be able to see all 4 of our model portfolios, and you could download the prospectuses here, and you could have a look at those and see. These can be traded by those who subscribe to our premium research product, or we manage money. We could manage that for you. If you're interested in any of that and having a discussion with us, or we could do a Zoom meeting, just go to the contact tab, say I'd like a Zoom meeting with you, and we will have a discussion about that and see if this is something that. Now let's get to the good stuff, and let's follow the money by identifying our key areas of focus as we look towards the election, and then what happens for the rest of the year. So we're going to go. First thing we're going to do is we're going to go back to the research center here. We're going to get back to the keys this week here in just a moment, by the way. But let's go to the research center, and let's go to the Asbury 6. The Asbury 6, the last time I was with you, I told you the Asbury 6 had been positive since September the 12th. During that period, it rode a 5% rise in the S&P 500 into the S&P 500's October 17th high. Asbury 6 shifted to a negative status on October the 25th, which so far has avoided a 2% decline in the S&P 500. So here's the Asbury 6, and you can see all 6 of the constituents are all red. What we've done here, excuse me, is the volatility in the market has increased tremendously over the past 5 to 10 years, probably more the past 5. There's a lot more algorithmic trading, a lot more computerized trading. We get a lot of days now, seemingly a lot of days, where you get up in the morning, the S&P is up 50, and then by lunchtime it's down 50, and then 2 days later it's up 75. It's very difficult to watch this and not need a cervical collar. What I did, after a guy that's been doing this for over 40 years, these gyrations were shaking me out of good ideas. So I needed a way my head focused on what's important and not get caught chasing the tail of the S&P 500. So Jack and I, my son and I, Jack's my business partner, and you see him in a lot of the videos, we started back testing all of the tactical metrics that I've had success using throughout my career, including when I was on the trading floor in the 80s and in the 90s. We came up with 6 that worked very well with each other, meaning they were diverse. They were different from each other. And if 1 or 2 indicators were giving you an incorrect signal, the other 4 would pick it up, almost like a team, an athletic team where you have 6 people covering for each other. That's kind of what the Asbury 6 does for the market. It's our daily updated risk management model that looks beyond the day-to-day volatility and noise to determine the market's actual health. It's updated every day about 2 hours after the close in our research center. What does it mean? It means right now the market is internally weak, it's internally vulnerable. In just a few minutes, we're going to go look at the key support level in the S&P 500 that is kind of hand in glove with this negative reading in the A6. If we break through that support level, this reading becomes a lot more significant. Next thing we're going to look at is the correction protection model. We're going to go back to the research center. This is a daily indicator. The Asbury 6 is an indicator. The CPM is a model. The CPM is our oldest model. We built it after the financial collapse in 2008, financial crisis, at the request of a lot of the money managers that we work with, whose clients were hurt on the way down. They stayed too long, and then they were hurt on the way back up because they didn't get back into the market quick enough. They were afraid to. They asked us to build a risk on and risk off metric that didn't trade very much. This only trades about once per quarter. But it's a completely data-driven, dynamic stocks bonds allocation model. Most folks that use some kind of a money manager, financial advisor, they'll have a conversation with you and they'll determine that you're a 60-40 man. You're 60 stocks and 40 bonds because of your age and your risk aversion and when you want to retire and whatever that might be. That doesn't make any sense to me. What makes sense to me is building a model that will tell you when you should be in stocks and when you should be in bonds, and not just doing a set it and forget it. I don't think they work very well. So what CPM is it's a dynamic stocks and bonds allocation model. When the stock market is internally healthy, according to CPM, and it has been since August the 15th, we are in SPY. SPY is the ETF for the S&P 500, of course. When the stock market is internally weak, vulnerable according to CPM, that would be when we are risk off. The model shifts out of SPY and into a short-term U.S. Treasury ETF. We use BIL is the one we use. So depending on the condition of the market and not what your set it and forget it was when you started working with your advisor, this is much more dynamic, and it's done quite well over the past 7-8 years. Historically, since 2017, the CPM model has essentially stuck like glue to the S&P 500, but with 40% less risk, 40% less drawdown. What does that mean? It means, especially if you're an older person, you don't have to wait as long to get that money back that you had drawn down. You were able to get back into the green faster. It has become extremely popular with older and more risk-averse investors, like I said, because it allows them to play the game with similar performance to the market, but without the volatility and drawdowns that keeps us up at night. Let's look at CPM, how it's done here over the past 15 months. You can see there was a lot of movement in the S&P 500 at the latter part, after the summer and fall of last year, let's call it. But once we went back to risk on, we went risk off on September 21st, avoided all of this. Then we went to risk on November 2nd, about 5 business days after the bottom, which is October 27th. We rode it all the way up to April 15th. Market started to weaken internally. We got out. When these turn, we don't know if it's going to go down for 3 days or 3 weeks or 3 months. Nobody knows that. It hasn't happened yet. But we got a dangerous signal here, so we went into Bill. Here we went back into the market. We bought back into the market. We sold Bill. We went into SPY. That took us all the way up to here, July the 25th, where we turned. We avoided this little move down here into the lows that we had in July, August, late July, early August, I believe that was. And then we've been risk on again since August the 15th. So not a lot of movement here, and we caught the vast majority of this move higher. That's what the CPM does. When the CPM turns to risk off, whether that's going to be tomorrow or after the election or whatever it might be, that's when we start making tangible changes to our portfolios. We start reducing equity exposure. We might start investing in different types of securities because of the condition that is expressed to us in the CPM. So that's how the CPM works. Next thing I want to do is display a few charts and data series that we believe are going to be particularly important to keep an eye on for market direction this week, into the election, and then after the election. These charts and analysis come from this past Friday's Keys to This Week report, which is a part of our premium research service. Contact us for the pricing on this service. So let's go to Keys to This Week. So we're going to scroll down. Keys to This Week, which was published on Friday. And there's 4 charts that I want to share with you today. Key U.S. index is testing critical support levels as the election looms. That's the title of this, and you'll see why in just a moment. Here's the first chart I wanted to share with you. This is the S&P 500 going back to January, showing you where the key support levels are. Right now, the key support level is the 50-day moving average at 5703. The July 16th and August 26th highs at 5670 to 5652. So rather large, about a 50-point spread, so to speak. But that's the convergence of 3 different very important support levels. If we break through there and we remain 4 or more red in the Asbury 6, we're currently 6 red as I showed you, and especially if the CPM goes to risk off, that means we're in a correction. It's time to do something about it. In our shop, it's time to do something about it. There's different things that different types of investors can do. Some are more aggressive and want to be in cash to a degree. Some just want to invest in different securities, but the important thing is below 56.52 with the A6 negative and a shift to risk off in CPM. We are in correction mode, and we need to be careful so we don't take a big hit on this beautiful move higher that we were fortunate enough to catch most of according to our CPM model over the past year. The next one we're going to look at is kind of a bellwether for what might be happening here. This is Microsoft. Microsoft is the second largest stock according to market capitalization. It has a very tight positive long-term correlation with both of the NASDAQs and also with the S&P 500. It carries a lot of sway in the market, and it tends to be a leading indication of the market. And here's where we are. We've been testing this support level here, which is the January 2023 uptrend line and the 200-day moving average here in orange, which is a major trend proxy, since August. Look at all these tests. Market sees this, it doesn't know what to do with it. If we start to break down through here, the lower boundary of this is 413, spot 37. We start trading underneath here for 2 or 3 days. That's a problem. That means this market cap behemoth that tends to lead the U.S. broad market is breaking a trend that's been in existence since the beginning of 2023. It's got a little bit of a negative lean for me right now because Microsoft is underperforming SPY. This is the corresponding relative performance chart of Microsoft versus SPY. You can see Microsoft started underperforming SPY on July the 15th on a quarterly 63-day basis. It tried to test that trend on September 17th and failed. Tried to test it again here on October 30th, also failed. So we're holding support, but we're with a downward lean. Watch Microsoft carefully next week, because I think it could be kind of a leading indication, canary in the coal mine, if you will, of what's to come as we see the outcome of the election. The next one that we want to look at is the VIX. Now, this isn't specifically the VIX. This is the IPAF Series B S&P 500 VIX short-term futures ETF. It's a mouthful. It's effectively a VIX surrogate. If it's above its 21-day moving average as it is now, it means the market is getting a little bit nervous. As long as it stays up above here, it indicates a drag on the market. There's a little bit too much fear in the market for it to make a sustained move higher. You can see when it spiked up here between middle of July and middle of August, that was the last big downdraft we had in the S&P. Watch the VIX, watch the VXX. You want to see that calming down and coming in and not going out further and not getting larger, not rising, let's say. Finally, the last one that we're going to look at today has to do with relative performance. Actually, there's two more. Let's take a look at cumulative volume in the NYSC. When volume is above its 21-day moving average, it indicates urgency to buy and the market goes higher. When it drops underneath the 21-day moving average, why 21-day? That's Asbury Research's tactical time period. So underneath from August 2 to 14, we had a downdraft. Underneath it, early part of September, we had a downdraft. We're starting to creep underneath it now as of the end of last week. If cumulative volume remains weak, it indicates a lack of urgency to buy, and I would look at that as a chip on the negative side of the scale for more weakness to come. The last one is relative performance. As I had said earlier, we're looking at relative performance between stocks and bonds. We're looking at relative performance between SPY and AGG, which is an aggregate bond ETF. When stocks are outperforming bonds, see here in green, above the 21-day moving average. Why? Because this is a tactical tool for us. The stock market likes it. S&P 500 goes up. When it dips below it, we get downdrafts. Look what's happening now. We are testing that 21-day moving average as of the end of last week. If it continues to go up from here, the S&P should resume its previous uptrend and go higher. If it starts spending 2-3 days underneath, as we did here during July, that's trouble. That means we're probably going to break that support that I showed you, and we're going to go into a corrective period. The last thing that we're going to look at are our ETF trade ideas. The last time I was with you, we talked about some of our ETF trade ideas. We're going back to the Research Center, and we're scrolling down to ETF trade ideas. So last time I was with you 2 weeks ago, I don't remember precisely which ones we talked about, but we had a lot of ETF trade ideas on. These are trade ideas. These are not long-term investment ideas, but rather trade ideas that we put on. We have a lot of clients that like to be active in the markets, and we try to capture opportunities in trading that are 4 different criteria. We need a positive price trend. We need a relative outperformance versus the benchmark S&P 500. We need expanding AUM in that particular ETF, and we also need an attractive risk to reward ratio. When those 4 criteria are met, they show up on our quantitative screening, and we look at those as a possible buy. So here you can see since October 23rd, we've had a lot of trades. We took profits in XSW for 4%. We took a 7% profit here In capital markets, KCE, another 7% we took here. In SLVP, which is metals and miners, we took 2 small losses here in PPLT and in the Qs last week, -4 and -1. And we are still long gold. We've been long GLD since August the 19th. We're up 9% outright on that idea, and we are outperforming the S&P by 7% thus far. How have we done on these? Are these profitable? Yes, we just updated our performance metrics through October, and since the middle of March in 2023 through the end of last month, we've had 81 trades, which is 4 trades per month. Our maximum drawdown has only been 2.8%. Our Sharpe ratio has been pretty impressive, at least to me, 1.7% on the collection of these trades. 50% of these trades were winners. 40% of these trades were losers. Average winning trade, 4.5%. Average losing trade, only 1.9%. So the percentage of winning trades at 50% is 17% higher than the percentage of losers. Average winning trade is 2.4% larger than the average losing trade. That's the secret to a successful trading system that you can use over and over and over again. You want to have more winners than losers, and you want to have your winners bigger than your losers. If you skin both of those cats, you've got a good system. The 1.7 Sharpe ratio tells us that the risk reward on these is extremely good. It's 18 or 19 months of trades. Average winning trade length in days is 18 days, I believe, and the average losing trade is 8 days. So we're in the winners more than twice as long as we're in the losers. During the past 19 months, our model has, on average, produced 1 new trade idea per week. And so that's another aspect of our service. I know a lot of you are interested in these shorter term trades. The only one that we're in right now is gold. And we also have a trade in IGV, which is the tech software sector. We've only been in it since October the 25th. We've got a really tight stop on it because of the election. We'll be putting on a lot more new trades after we get past the election and kind of get a handle on where we're going into the new year. So there it is. That wraps up Asbury Research's Following the Money podcast for this week. Our next Follow the Money podcast is tentatively scheduled for 2 weeks from today, which will be the 17th of November. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in financial markets and our own data-driven models. Again, you can request more information about us by visiting the Contact tab, asking for a Zoom meeting or a phone call. Have a nice Sunday. Go Chicago Bears. I hope to see you in 2 weeks where we can see how this election turned out and where our next opportunities are going to be as we look into 2025. Thanks, and have a wonderful Sunday.